Welcome back to Investing Talk Podcast.
Today, we're looking at Palantir Technologies.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps us out with the algorithm and lets us know what you want to hear next.
Absolutely. And look, we have to talk about Palantir right now because the narrative around this company has it's undergone a complete structural shift.
Right.
For the longest time, Wall Street put them in a very specific, maybe slightly shadowy box, you know, secretive government contractor, niche software for spies.
A little bit dystopian, maybe?
A little bit, yeah. But they just delivered Q4 2025 results that didn't just open that box. They shredded it. They aren't just a contractor anymore. They are rapidly becoming the AI infrastructure backbone for the entire U.S. commercial sector.
Okay, let's pause right there. I want to unpack this immediately because when I hear phrases like AI infrastructure backbone, my buzzword alarm starts ringing a little bit. We are in the middle of a massive hype cycle. I see the headlines, I get the AI excitement, but we have to acknowledge the elephant in the room. The stock has been on a roller coaster. It's been volatile.
It has.
So I have to ask the skeptics question right off the bat. Is this real, tangible growth based on cash changing hands, or is this just more noise from the AI bubble?
That is exactly the right question to ask. But when you strip away the marketing and just look at the hard data from this report, the so what is, well, it's undeniable.
Okay.
We aren't talking about projected potential or, total addressable market dreams here. We are talking about hard numbers on the board. Revenue is up 70% year over year.
70%.
And more importantly, they didn't just beat guidance, they crushed expectations. This isn't about landing one giant government whale of a contract. This is about compounding adoption. It's scale.
70% growth for a company that was already valued in the billions is, it's a lot. Usually gravity kicks in. The law of large numbers starts slowing things down. So let's dig into the actual report. Where is this money actually coming from?
So in Q4 2025, total revenue hit $1.41 billion.
Okay.
That is a 70% increase compared to the same time last year. That is the fastest growth rate in their history as a public company.
Wow.
To put that in perspective, most mature software companies, even the good ones, they're thrilled with 15 or 20% growth. Palantir is moving like a startup, despite being a large cap.
Okay, 1.41 billion in a single quarter. That is a serious number, but again, I'm playing the skeptic here. Is this just the government writing a bigger check? Because we know global security is, let's politely call it a growth industry right now.
It certainly is.
Is this just Pentagon spending ramping up?
That's the fascinating part. The government side is incredibly strong. U.S. government revenue rose 66% to $570 million, which, it makes sense given the geopolitical climate.
Right. Wars, tensions, the defense budget is flowing.
Exactly. But the real driver, the thing that's making the market sit up and realize this is a different beast, is the U.S. commercial side. It just exploded.
Exploded how? Give me the breakdown.
U.S. commercial revenue jumped 137% year over year.
137%.
Yeah.
That's doubling and then some. That is, frankly, ridiculous for enterprise software.
It is. And even if you just look at it sequentially.
Pointing from the previous quarter to this one.
Exactly. It's up 28%.
Right.
That is massively outpacing broader enterprise software trends. Think about it. While other SaaS companies, Salesforce, Workday, the usual suspects, are fighting tooth and nail for single-digit growth because companies are tightening their belts.
Right.
Palantir's commercial business is more than doubling.
That represents a staggering disconnect from the rest of the software market. Usually when the macroeconomy gets wobbly, enterprise software is the first thing CFOs cut. They cancel subscriptions, they consolidate tools. So who are these customers? Are they just signing up to try it out, or are they actually sticking around?
That brings us to customer depth. This is a metric I love because it cuts through the noise of new signups. Trailing 12-month revenue from their top 20 customers is up 45%.
Okay.
It is now at $94 million per customer.
Wait, let me process that. $94 million per customer. That isn't a pilot program.
No.
That isn't, let's see if this chatbot works for customer support.
Exactly. That's what I mean by a structural shift. These big clients, we're talking enormous multinationals, maybe energy companies, maybe logistics giants, they aren't just dipping their toes in. They are locking in deeper.
So they're expanding their contracts.
They're expanding. It means the software is becoming sticky.
Yeah.
In the software world, we call this net dollar retention. Once you're in, you don't leave, and you spend more because the software becomes the operating system of the company.
Right, which implies it's actually solving a problem, not just looking cool in a boardroom presentation. So what is the engine here? Is it just the Foundry platform, which they've had for years, or is this the new AI stuff?
It's the AIP, the artificial intelligence platform. That is the why behind this surge.
Okay.
Demand for AIP is accelerating because it's moving past that experimentation phase that every company went through in 2023 and 2024.
Right, when everyone was just playing with ChatGPT, asking it to write emails or whatever.
Totally. Now it's moving to mission-critical operations. Companies are running their logistics, their supply chains, their actual businesses on this.
Okay, so they had a great quarter. But the stock market is a forward-looking machine, right? It doesn't care what you did yesterday. It cares what you're going to do tomorrow.
Always.
What are they telling us about the future? Because usually when you have a blowout quarter like this, management tries to temper expectations. They sandbag the guidance.
They do. So they don't set the bar too high and disappoint everyone later. Not this time. Management is explicitly guiding for 61% revenue growth in 2026.
61% growth. That seems aggressive. That is putting a huge target on their back.
It crushes the consensus expectations by 15 percentage points. It's unheard of for a company this size to guide that high above consensus.
Wow.
To put it in perspective, Morningstar, who is notoriously conservative, is now forecasting 43% average annual growth through 2030. They are comparing Palantir's trajectory right now to Salesforce in the late 2010s.
Salesforce in the late 2010s is the comparison every investor dreams of. I mean, that was the golden era of cloud adoption. But let's talk about the bottom line. Growth is great, revenue is vanity, profit is sanity.
Right.
Are they burning cash to get this growth? Because 70% revenue growth usually comes with a bonfire of cash burn on marketing and sales.
That's the profitability bomb they dropped in this report. Adjusted operating margin reached 57% in Q4.
57%.
They beat their own guidance on that by 500 basis points.
57% operating margin. That is software scalability nirvana. That basically means for every dollar they bring in, they keep 57 cents of operating profit before taxes and interest.
It really is. It destroys the narrative that they can't be profitable.
So if we look at the Rule of 40, and for you listeners who might not be familiar, that's a quick back-of-the-napkin metric investors use to judge software companies. You simply add the percentage growth rate plus the profit margin percentage. If the number is over 40, the company is elite.
Right. So do the math with me. You take their growth, which is hovering around 70% plus that 57% margin.
Okay, 70 plus 57.
For Palantir, the Rule of 40 score is at an all-time high of 127%.
127. That isn't the Rule of 40, that's the Rule of 120. That is absurd efficiency. It breaks the scale.
It shows that as they scale, every new dollar of revenue is flowing through at incredibly high margins. They aren't spending exponentially more to get that next customer. They also closed their largest total contract value, or TCV, quarter ever at $4.3 billion.
So that's $4.3 billion in future revenue locked in.
Locked in.
That does provide a lot of visibility. It reduces the risk that next quarter falls off a cliff. But I have to ask the hard question here regarding the technology. What is stopping Microsoft or Amazon or Google from just doing this? They have the cloud, they have the LLMs. What is Palantir's moat? Why pay them?
It comes down to their ontological framework.
The ontology. They love that word. It sounds like a philosophy class, not a tech product. Can we explain that in simple terms? What does ontology actually mean in this context?
Think of it like a digital twin. Most companies have messy data spreadsheets here, PDFs there, emails everywhere.
A total mess.
Right. An LLM, like GPT-4, doesn't understand how those relate to the real world.
Right.
It doesn't know that component X in a PDF is the same as part X in the warehouse database. Palantir's ontology maps the data to real-world objects. It tells the AI, this row in a spreadsheet is a truck, and this row is a driver, and this truck can only carry 5 tons.
So it gives the AI the rules of the road. It gives it context.
Exactly. It gives the AI logic. Morningstar points this out specifically. There is a lack of a true competitor to this framework. It allows companies to create a digital twin of their business. Palantir isn't just selling a point solution or a chatbot. They are acting as a model orchestrator. They sit on top of the LLMs, whether it's GPT-4 or Claude or whatever, and they make those models actually interact with the company's proprietary data safely without hallucinating.
So that orchestration capability is the moat.
That's the moat.
So they're the translation layer between the raw, chaotic AI smarts and the structured, boring reality of a business.
That makes a lot of sense.
Yeah.
Okay, the fundamentals, They sound rock solid, frankly better than I expected. But the stock chart, it tells a pretty complicated story. So let's pivot to the charts and the price action.
Let's do it.
Because despite this earnings beat, the stock had been weakening heading into the report.
Yeah.
There was some serious sector rotation going on.
Yeah, that's true.
We saw money moving out of high-flying tech and into value names.
Context is key here, absolutely. In fact, the stock had recently plunged 37% from its all-time high. That is a bear market crash in a single stock. It was driven by these fears that the AI trade is cooling off, that the hype cycle is over.
And that context is so important. You had a stock that was technically broken, down 37%, sentiment was muted, and then bam, they dropped this report.
Right.
The earnings beat triggered a sharp rally immediately. What we are seeing is a collision. You have the fundamental reality of 70% growth colliding with a technical downtrend. That creates a massive inflection point.
It's a battleground. You have the positive momentum from the beat fighting against broader software sector weakness, because let's be honest, the software sector has been ugly lately.
It has. But Palantir is acting like an outlier. That's the key takeaway on the technicals.
Yeah.
When your peers are growing at mid-single digits and sliding in price, and you were growing at 70% and rallying, you were gaining market share.
You're sucking the oxygen out of the room.
That's it. This divergence suggests that while the AI trade generally might be cooling, Palantir is separating itself from the pack. It's becoming a flight to quality.
Essentially, investors want AI exposure, but they are tired of vaporware. They want the company that's actually making money from it.
Exactly.
So how is the street feeling about this? Let's look at sentiment, because I know the analysts have been skeptical of Palantir for years. They hated the valuation. They hated the stock-based compensation.
Hated the black box nature of the business.
Totally. Has that changed?
It's changing fast. In just the last 60 days, we've seen 10 analysts revise their earnings estimates upward.
Okay.
The Zacks consensus estimate for earnings didn't just inch up. It jumped from $0.30 to $1.34 per share. That is a massive recalibration.
That's a 4x increase in earnings expectations. That tells me the analysts were completely behind the curve. They were asleep at the wheel.
They were playing catch-up.
Yeah.
Zacks now has them at a rank, #2, buy. And Morningstar, who, again, is usually very conservative and very valuation conscious, they raised their fair value estimate from $135 to $150 per share.
Seeing Morningstar chase a price target up is definitely notable. They usually like to drag things down to earth.
Right. And it's not just the analysts. We have to look at the institutional flows. The smart money. Billionaire investors have been accumulating shares. The stock is up 970% since early 2023, and yet you see these heavy hitters continuing to buy. They aren't cashing out.
They're doubling down.
They're doubling down. And there was a specific partnership mentioned in the research that caught my eye, Cognizant.
Ah, yes.
The Cognizant partnership is a huge bullish signal. Cognizant is a massive IT services firm thing, back office implementation, consulting, the plumbing of the corporate world. For them to partner with Palantir to deploy the AIP platform tells you that the traditional IT consultants realize they need this tech. It validates that Palantir is becoming the standard.
It's basically the stamp of approval from the boring corporate world. It says, this is safe for enterprise. So, if you had to score the vibe right now.
I'd summarize the sentiment score as mixed to bullish.
Okay.
The numbers are unequivocally great. The analyst upgrades are great. But the mixed part comes from that macro fear. That heavy, wet blanket of, is AI sustainable, is still weighing on the broader market. And Palantir can't escape that gravity entirely.
Right. If the whole NASDAQ dumps because of inflation or geopolitics, Palantir goes with it. It's not immune to the tide.
Exactly.
But we have to look at the risks. We can't just talk about 70% growth all day. Let's execute a deep dive into the bear case. Because as an investor, I look at the price tag on this stock and I get a little vertigo.
It is steep. There's no getting around that.
Palantir trades at roughly 90 times trailing 12-month revenue, not earnings, revenue.
90 times sales.
That is a 350% premium over other AI firms.
It is priced for perfection.
The logic here is that to justify paying 90x sales, they must maintain 30% plus annual growth for 5 years straight. If they slip up, if they grow at 20% for just one quarter, the stock crashes. That multiple compression would be brutal. It feels like walking a tightrope without a net.
That is the primary risk. When you are priced this high, you have zero margin for error. The market is pricing in a dynasty, a generation-defining company. If they deliver anything less than that, the correction will be swift and painful.
And then there's the competitive threat. We talked about the moat, but there is this commoditization argument. AI inference costs are dropping like a rock.
They are.
Large language models are converging. GPT, Claude, Llama, they are all getting similar. If the underlying intelligence becomes a cheap commodity like electricity, does Palantir's software look too expensive?
That's the race to the bottom fear. If AI becomes free, why pay Palantir millions? The bear argument is that Palantir is just a wrapper around other people's models.
Right. And if the wrapper costs $10 million, eventually someone builds a cheaper wrapper.
Exactly. The counterargument, of course, is that the value isn't the model. It's the orchestration and the ontology we discussed. But it's a valid long-term concern. If AI becomes easy enough to implement without help, Palantir loses its edge.
And one more thing on the bear side, the TAM total addressable market. Critics have always argued Palantir has a Western ethos cap.
Right.
They only sell to Western-aligned allies. They aren't selling to China. They aren't selling to Russia or their affiliates. Does that limit how big they can get compared to a neutral software player?
It's a real constraint, geographically. You can't be a truly global monopoly like Coca-Cola or Apple if you refuse to sell to half the world.
So how do you mitigate these risks? You're sounding pretty bullish today based on the numbers. How do you square that with the valuation?
Well, on the valuation, I'd argue that the 61% guidance provides a safety buffer. If the market demands 30% growth to justify the price, and they're delivering 61%, they're actually growing into that valuation faster than people think.
They're burning off the premium by executing.
That's it. They are outrunning the multiple. And regarding the TAM, we are seeing them expand into Arab states. Management explicitly mentioned this.
Okay.
That challenges the Western-only thesis. They are finding allies and customers in the Middle East, which opens up a massive new market. Plus, their ontology creates those high switching costs. Once a company builds their entire digital brain on Palantir, they aren't going to switch just because a cheaper LLM comes out. The cost of ripping it out is too high.
The classic vendor lock-in. Everyone hates it until they own the stock.
Exactly. It's the same reason people don't switch away from Microsoft Office. It's just too painful.
Okay, we've looked at the blowout numbers, the scary valuation, and the technical inflection. It's time for the final verdict. Where do you land on Palantir right now?
When I weigh the hypergrowth against the valuation risk, I have to award a bullish score of 8.510.
8.5, that is high given the valuation concern.
It's high because this is a rare combination. You almost never see a company delivering 70% revenue growth and 57% operating margins simultaneously.
You pick one or the other.
You pick one. You either grow fast and burn cash, or you grow slow and print cash. Palantir is doing both. The shift to U.S. commercial dominance is structural. It's not a fluke. They have crossed the chasm.
I have to concede slightly here. It is expensive, painfully expensive, but the execution is undeniable. You can't argue with the scoreboard.
Exactly. My outlook is that this is a 12, 24-month hold. This isn't a day trade. You need to let that compounding growth work for you. The next major catalyst will be the Q1 2026 earnings in May. We need to see them do it again.
And price target.
We're looking for a move to the $150, $180 range over the next 18 months. That assumes they hit that 61% growth target and the market keeps giving them a premium multiple.
So $150, $180, that's significant upside from here, even after the rally. It seems the spy company has officially become the AI company.
That's the story.
Well, that's the breakdown on Palantir. If you enjoyed this analysis, make sure to subscribe, like, and comment below. We'll see you in the next one.